Geared for Growth. I'm your host, Mike Mortlock, Managing Director of MCG Quantity Surveyors. Now today we're talking about the evolution of a property investor that perhaps has one property or just about to start buying property. How do they transition from that first acquisition to a point where they have some financial freedom or some cash coming in that enables them to make choices on what they want to do with their life? And who better to ask the question than the man himself, Paul Glossop from Pure Property Investment, who's also the author of A Surfer's Guide to Property Investing. Now, surfing, I think, is a metaphor for freedom for this interview. And we talked to Paul about how you can start out. Are there price points that he would purchase at and price points that he wouldn't? You know, what are some of the considerations with cheaper properties? And how do you actually transition your portfolio from acquisition to the point of cash flow positive where you have that financial freedom? Paul shares some awesome tips on his journey and the work that he does with his clients that I'm sure you'll get something out of. Here's Paul. Paul Glossop, thanks for joining me on Geared for Growth.
Mate, thanks for having me.
I've been looking forward to having you for a while. And of course, you know, your reputation precedes you with your Surfer's Guide to Property Investing, obviously a very successful book that you wrote a couple of years ago. How has that kind of changed things for you? Is that something that people cite when they're getting in touch with you these days?
Yeah, it definitely is. It probably wasn't the intention, way back when, sort of 4 or 5 years ago when I first started putting it together. It was about a 12-month mission to document about 250 odd pages of a property investment journey. But I guess since then, because it has been something that probably speaks to a lot of people in a lot of different stages of life. It's not necessarily, I didn't write the book as probably as a technical guide as to how to invest in property and sort of go from it step by step. It was more so saying, here's where we start, here's the options that you have available, and here's ultimately what my objectives and what property investment had as far as my own goals and how it's sort of taken me to where I really want to get to, and the values that come with, getting to a particular point from a financial freedom standpoint, and how property was, was my vehicle and how to get there. But there's been a lot of people who resonate with the story, which has been amazing. And we're actually probably about 3 months into version number 2, which is essentially an updated guide, and more so about the catch cries, the Surfer's Guide to Property Investing, how to find the exit. So how if there's any surfers who are listening in, they'll probably get what I mean when I'm sort of talking about the metaphor of finding the exit, as opposed to not necessarily just in property. But yeah, I think for me it's an evolution book, and I think everyone can pick out the parts that they relate to. And it's not just about the data, it's not just about property, but it's about sort of everything that goes with why most of us invest in property, which is essentially to find some sort of, I guess, some sort of reason and rhyme to financial independence and do with our lives what we really want to do.
I love that, because this is really the focus for the topic today, is the evolution of a property investor. So, you've dropped into a wave, spent some time in the blue room. Obviously, you've got to pick that exit. You can tell I'm from the country and never really. I grew up driving a postie bike in irrigation canals, and every now and then we would pull a rope behind it with standing on a board. But I don't think that counts. But you don't have to be a surfer to enjoy the book, right? I mean, surfing is more of a metaphor for freedom. So for you, you wanted financial freedom to go and surf, to spend time with your family, to give back to the community. So surfing's just kind of your metaphor for the journey, right?
Yeah, absolutely. And I think we can all probably resonate with that pretty clearly, is that, if we had the ability to say, look, I wake up in the morning and my first objective is not necessarily to figure out how I'm going to make the amount of money I need to get to a particular financial position. Ultimately, if we get to the point where property can deliver what it needs to deliver, to then wake up in the morning or set your plans for the next week, the next month, next year, to say, look, my goal this week is to spend X amount of time with my kids, or X amount of time with friends, or make sure we're divulging further into pastimes that might be given back to the community. All those things which most of us in any way, shape or form probably have desires to do more of than we currently do. I think the surfing, absolutely, for me, I love surfing as well. So for me, finding time to put that into my weekly calendar is pretty much a non-negotiable. But for me, it's sort of trying to figure out things that make you a better human. And typically by being a better human, I find that you end up being far better at all the other things you do with life, be it a husband, be it a father, be it a friend, be it a son to my mum, all the other things that go with it.
Yeah, and I guess the stress and the strain of paying the mortgage, or paying for the bills, is something that's going to detract from all of that. And you've been able to achieve that financial freedom. And for people that maybe haven't come across you before, typically your model, for want of a better term, is established properties, anywhere from the sort of the 300K to $3 million mark. For the people that are starting out in their property journey, so if we're talking about the evolution, you have to start somewhere. And you're saying that there are deals around that $300,000 mark today where people can actually get into investing for perhaps a lot cheaper than what they thought they could.
Absolutely. And I think that's probably the biggest challenge, is that the vast majority of property investors and also just people in Australia live on the eastern seaboard, and predominantly, whether it's Sydney, whether it's Melbourne, or potentially Brisbane, that's the bulk of our population. And if you dig a bit deeper into Sydney and Melbourne in particular, and you're trying to find a freestanding established house at $300,000, you're essentially going to be looking for a very long time, because unfortunately they don't exist anymore. But the reality, I think, is that there are certainly markets right across Australia right now, and I'm not talking far out regional markets, which are, for lack of a better term, one pub towns. These are markets with robust, 1-2 million population within half an hour, 45 minutes to major employment hubs, lifestyle centres, school catchments, universities, hospitals, all those things that you want to look for established long-term growth. We work with property investors, and I actually just worked over the last probably 4 or 5 months putting together a Fast 50 guide, which effectively looks at markets across Australia, the top 50 markets which we assess at Pure Property Investment, that are looking like they're going to be the best markets for growth over the next 24 months. There's a number of markets. I can speak of one, Armidale in WA, or Perth. Again, it's an entry-level market, but again, 40 minutes from Perth CBD. Average house price in Armidale right now, $305,000, yield of about 6%. Average annual growth is quite low. Last 12 months growth is about 11%. And I don't want to go too much straight to data and solutions, but my point with that is that if you look and you know what you're looking for, rather, and you sort of have a budget that's constrained, it's not to suggest to say, hey, look, if you're sitting there thinking I can only get my hands on $300,000 or $400,000 to kick it off, the solution isn't to say, hey, you need to sit back on the sidelines for another 3 to 5 years to get some more money together or earn some more so you've got a bigger borrowing capacity. It's essentially saying, start with what you can work within and then try to find solutions there, as opposed to think, well, I don't have solutions in that budget, so I guess I might as well just sit back and be one of those naysayers who say it's far too out of reach for the average 20-something or 30-something-year-old.
I love that. We have actually had guests before that said, if you don't have $500,000, $600,000, $700,000, their advice is come back when you do. So it's nice to hear from someone that says, look, you don't have to have that amount of money. Our data is telling us that the average person spends about $689,000 on an investment property, but a proportion of those, around about a quarter, are actually buying something that they will occupy later on. So the real number could be a little bit less than that. But it's nice to know that, we're talking about the evolution of a property investor. You can get in the market at that point. But what sort of sacrifices are you making at that price point that you wouldn't be at, say, 800,000? Are you sacrificing potential upside capital growth? Presumably you're not sacrificing your yield, but are there more risks with the quality of tenant or maintenance? How would you categorize the risks in that?
It's a really interesting one, I think, from my side of things. Is probably a couple of things there. You're very rarely going to be sacrificing gross yield when you're dropping down the price point, and that's a pretty obvious calculation. I don't want to sort of dig too much into that. I think some of the misnomers that I personally think exist in the property market in general is that you drop down to a particular price point or you enter into a particular area and all of a sudden your caliber of tenant, and that's a very subjective way that I think people look at it, and maybe sometimes people use it against having to invest or wanting to invest in a particular area. But the data side of things on a caliber of tenant versus what they actually do to your property that costs you X amount on an annual basis or over a 10-year period, that's something that I've personally never seen any data to suggest. If you own a property in this market versus a property in this market, and one's deemed to be entry level, the other one's deemed to be blue chip, show me the percentage of actual annual running repairs that are higher due to the actual tenant or potentially vacancies or arrears in rent and a range of other things that might be perceived. So I think for me, sometimes it's sort of dispelling some of those myths. when you look at it, you really need to understand, all the basics that go into it. But I think if we sort of get away from that for a second and don't go too deep into that component, I think the thing is typically if you're sort of having to get in at 300 or 400 grand or even lower, because I can speak to markets such as Devonport, Burnie, Launceston, that 3 or 4 5 years ago we probably bought we bought a lot of property in those markets as a buyer's agency. But I think I could struggle to count on one hand how many properties above 300,000 we bought in those markets back then. They were probably more in the ones and twos. And those markets at the time were yielding 6, 7, 8, 9, 10% in some cases, and have done really well from a growth standpoint. What you're sacrificing potentially is usually, if you're going regional, then obviously you're sacrificing the potential for long-term evolution or gentrification of those markets, which can lead from them going from a $300,000 to a $400,000 market, but probably more so, how do they get from a $300,000 or $400,000 market to a $900,000 to $1 million market? They're the parts which sometimes become complicated, I think, if you're outside of a major capital city, and you don't have those additional pressures on actual land value. For me, that's the big one, is that if you go too regional or too far to the fringes, you push to the point of actually really pushing to the point of that land becoming not the restricted component of the overall purchase. And for us, that's the part which we're always trying to balance is, yes, we've got a budget, but you always need to consider, say, if I'm buying a property that fits my budget, great. If the yield's there, that's great. But what's going to push the overall demand? And the demand's not necessarily just, hey, is it affordable and people can live there? But if that starts happening, how much available supply nearby, be it greenfields locations, changing to zoning, and potentially just overall things like population growth and overall demand from people moving into those markets to put up pressure. So I think that's one thing that people need to consider. A lot of the time, and you probably know this far more than I would from your end, Mike, is the reality is that a lot of the time those fringe markets also get dominated by big brand new developments. And when we're talking big brand new developments, greenfield sites of 100, 200, 300, 1,000 plus properties that can enter a market in a 1, 2, 3 year period of time. That extra supply that can be created in a quick fashion is sometimes a big component that you need to be very aware of, because that's what's going to restrict your overall growth over the long term.
Yeah. A lot of really good points there, Paul. And I love that sort of challenge on the data of that basically sort of says people with less money are more likely to do criminal damage to a property.
Yeah.
I've never seen anything like that. And I think that sort of does a bit of a disservice to a proportion of the country. And I probably would define myself as having been in that category for a period of time as well.
Absolutely. Likewise, mate.
Yeah, that's an interesting one that I think we could all do well to analyze a little bit more. But yeah, I guess that what I learned most from that is that there are some upside caps potentially to going from 300 to $1 million market, and that might require that gentrification happens, which is less likely to happen in, say, regional markets. But you're still kind of extolling the virtues of getting in when you can at the price point you can, and perhaps the next investment where you can leverage that first one. That's where you can look for those ones that might be at that $500,000 or $600,000 point that do have a future in the millions. Would you say?
Yeah, that's a fantastic, I think, point into the whole aspect here. Is that I'm not suggesting that it's saying, hey, if you've got a budget of 300 to 400K and that's where you start, that's not where you end up. For me, and I guess our philosophy from a buyer's agency and a property investment standpoint is certainly not the person with the most amount of property wins the game. It's certainly the person who gets to where they need to get to with the least amount of moving parts, typically is the one who's going to get to that ultimate objective far quicker and far more seamlessly. And that typically means they're saying, hey, look, we're looking to get the best outcome with the means that we have. But if we're starting with 300 or 400 grand as that first purchase, and I can work through a number of examples, but let's say hypothetically you get the increase to $450,000 within a defined period of time, you have the ability to extract equity, and your budget, from that next investment might increase with additional incomes, maybe double incomes, etc. And all of a sudden you've got 600K to work with, as opposed to thinking, okay, I've got 600K, that looks like $200,000-$300,000 investments, and now all of a sudden I go from 1 to 3 properties. We would rarely suggest that is going to be the solution. And I think more so it's to say, hey, look, you can usually get the same objectives or the same KPIs achieved within a 500 to 600K budget as you can with a 300 to 400K budget, be it yield, be it growth upside. but you potentially can move into a slightly more premium market, or potentially a market that might have a larger piece of land, potentially to add value, potentially to subdivide, potential to add cash flow from a granny flat, a range of other things that you just simply would be restricted on if you're in that 300 to 400K market. So for us, that is typically the way it works, is that you start where you can, don't delay, but once you've got in and you can go again, that's when you consider saying, do you push the envelope and push harder and higher to a higher price point? And also, when the amount of times we had that discussion about, do you wait for a 20% deposit to be available, or do you push the envelope a bit and say, look, I'm building the portfolio, so I'm comfortable taking a bit more risk, so let's go after a 90% lend, pay the lender's mortgage insurance, be a little bit more geared in the early stages, and then over time you start to drop down that gearing to essentially go through the process of reducing your risk and your overall leverage and increasing your cash flow. That's typically the evolution that we see come out of most investors over that 5, 10, 15-year period.
Awesome. I couldn't help but sort of have a little cheeky thought in my mind when you were talking about we wouldn't recommend someone split 600 into 2 lots of 300, because that's kind of against what we hear in podcasts and in the media. You know, I've got 2 properties, I've got 3 properties. Well, you know, I'm better than you because I've got 3 and you've got only 2, or I got 10 in 10 years, or my goal is to have 20, with no discussion about the value. Or, you know, you could have 3 properties that could be better than 30 properties, right? It's such a pervasive thing in property investing. People sort of get bewitched over that. But would you just describe that as an ego metric we need to get past?
Unequivocally, and I couldn't count how many times clients or potential future clients of ours, when I'm having initial client discussions with people who come and have a chat with us about setting that strategy, they do ask me the question, what does my portfolio look like? And they don't necessarily ask the question about, what does it look like, value, cash flow, how did you exit the workforce, all those sort of questions, which it's not necessarily what I intend to discuss. But typically that question comes and saying, how many properties do you own? And it's irrelevant. The answer is irrelevant. That part, and to your point further to that, I mean, unfortunately, I think people do like it. It's good clickbait, it's good fodder, and it does get people to stare at a screen. 30 properties in 3 years, or whatever it might be. And there's no shortage of people who put their their company's marketing spin based on those numbers. But it is pervasive. Ultimately, though, it has very little bearing on what the outcome is. And I think, to my earlier point, we're huge proponents to say the least amount of moving parts to get to the ultimate goal is really our job. And I talk myself out of business very regularly. As a buyer's agent, we charge a flat fee to buy a property. And it might sound a bit counterintuitive as a business owner to say, well, if you can split 600 into 2 properties and essentially make 2 fees out of a client, you should be thinking about that. Well, for us, the bulk of our clients are repeat clients, all referred from an existing client. And we know that if we want to have a business that is sustainable, we want to see clients of ours, really get good outcomes. And that's our job, is to figure out where those outcomes are going to come over time. And the rest of it will do its own work.
Yeah, I love that. I think, if you're a business that's been around for a long time in your industry, that's obvious that you're putting the outcomes of the client before that revenue, right? The Geared for Growth Property Investing podcast is presented by our business, MCG Quantity Surveyors. If you're an investor or a property professional looking to get the best tax depreciation deductions for yourself or your clients, please get in touch with us at mcgqs.com.au. It's our mission to help as many property investors as we can to maximise their claims and maximise their property education as well.
Yeah, it has to be that way, and you know it full well, mate. Is that there's so many ways you look at it, but longevity is number one, and ultimately it comes down to saying, well, what would I do? And one thing I'm very conscious of is within our team we have 9 staff members. Every single one of them are property investors. I've got 4 buyers agents. They all have portfolios that are very robust, and they're buying property and building their portfolios for over a decade, each one of them. And that's one thing we've always made, is that anyone we hire within our business has to be a property investor, because otherwise we just find they typically are doing it to get a paycheck as opposed to really have skin in the game. But that's the big part, is that we want to make sure that if we're doing it for the right reasons. And you just know that feel-good factor of it all, knowing that you're never going to go to sleep thinking that was the wrong choice, or that's the wrong call, or we're doing all this for the wrong reasons. It just never comes back to bite you.
Mm. Yeah, I suppose I feel for the consumer, right? Because someone will come to you because they want to be presumably a multi-property portfolio owner. They look at the surfing and they understand, okay, well, maybe a better question for Paul rather is
Mm,
how many properties does he have, or how much does he surf? Right. That's a
yeah,
better
yeah,
indication of a metric of where they want to be. People want that financial freedom. So it's I can forgive people for asking that question, but what is a better
agreed.
question for them to ask rather than how big's your portfolio or how much passive income you have, because that's something that I wouldn't want to share with a stranger.
Yeah,
It's kind of like that. It's almost a question that you sort of have to give to them to make them feel comfortable that you're the right fit.
completely. And I think for me, a really good question to ask, and it's kind of in its own sort of, I guess, some not necessarily back to front, but it's in its own sort of snake-like manner way when we have those initial conversations. The part that we try to get to is, okay, well, if I was in that person's position and I knew where they wanted to get to, what would we recommend they do to get to where they want to get to? And ultimately set that strategy. And that part is, for me, is key, because where I started my investment journey, where you started your investment journey, where the next person's going to start theirs, are always going to be different points. They've got different incomes, different leverage points, different time constraints, different incomes they want to earn long term. They've got different perceptions as to where they want to get to, and also what success looks like to them. And you have to then be quite flexible to say, well, I don't want necessarily people to come to me and replicate what I've done, nor do I want them to replicate what someone else has done. I want to understand where they want to get to. And then for me, the best question is saying, well, if you wanted to get to where you want to get to, or someone asking me if I wanted to get to where they wanted to get to, how would I do it? And how would I reverse engineer it based on what we've done in the past and what we'd suggest we're going to do in the future? And inadvertently, to your point, mate, it's never going to end up being a solution of one property. And we did speak about, the less moving parts, the better.
Yep.
But it's never going to get there with one asset, or very rarely would it be with one asset. It's typically going to be a staged out purchase plan. But very rarely, in that same token, would I suggest that the plan needs to include probably more than 4 or 5 assets over the long term. And that would probably even be sold down to potentially 2, 3, maybe 4 assets would for the most part, for the vast majority of people, do the bulk of the heavy lifting over a 15, 20, 25-year journey.
Well, that's good. Let's give you some hypothetical room to flex that muscle. We've talked about perhaps buying in at 300 grand, looking at the next opportunity in more of a robust location that could have some gentrification. How do people get from the point of having 1, 2, 3, maybe even 4 properties that are either negatively geared, or they might only be partially positive? If they're bringing in $20,000-$30,000 a year, that's not necessarily freedom yet. How do you transition to that point where we get to go surfing?
Yeah, good question. If we're hypothetically starting and we've got, let's say, a principal place of residence that might be owned, and someone's looking to leverage off their home as an example and then start to build a portfolio, that's a very common one, because the starting point is either I'm going to rent vest, or I've got my home, we've got a bit of equity and we want to get to a particular period of time. We'll get to a particular position in a particular period of time. Realistically, to get there, we usually have to say, hey, look, if we want to get to financial independence, and whatever that looks like, I would say usually 80 to 100 grand a year is going to be sort of having to be the starting point. If you want to have a choice of, do you go to work? Do you spend your time volunteering? Do you travel for a living? Whatever it might look like, I think you kind of really need that amount of money, plus your accommodation, whatever your accommodation looks like, pretty much paid for. So no debt, or essentially no rent, however that looks. To work backwards from that, that's usually going to be, $2.5-3 million in gross assets, net assets rather, on typically a 4 to 5% gross rental income, which is going to give you that sort of circa $140,000 gross. Take off some expenses, you're in that $80,000 to $100,000 income. So if we sort of say, here's the end goal, and sort of we need $2-3 million in assets with no debt against them at about a 4 to 5% yield, for us is to say, how do we get there? That's a pretty big mountain to climb. It's not exactly saying, hey, no problems, you buy 4 properties, they compound in growth over 10-year period, you sell 2, keep 2, and the rest is all going to be worked out in the wash. For us, it's usually saying, look, the first part is that you cannot sacrifice time. There is no shortcut to getting there. For us, if you're wanting us to come to us and say, hey, look, here's the secret spot that everyone should be buying, and you should buy 10 properties here because it's going to triple in the next 4 years, yeah, we certainly won't be giving any answers that'll be, but anything close to that. And if anything, I'd be walking the opposite way the moment I hear about, some secret hotspot per se. But I think for me, if you don't have a horizon that's probably more than 10 years, I personally would suggest don't invest in property, because it just simply is not going to be enough time to get the bulk of at least one growth cycle. And when I say one growth cycle, you're typically talking that overall 7% annual compounded growth. Not to say that it's going to happen annually, but typically that's what you want to achieve. And that has to happen over a 10 to 14 year period based on the last 50 years worth of data. So invest for a 10-year period minimum. And if you have starting from ground zero, you need to be comfortable with debt early in the piece. And when I say comfortable with debt, your leverage has to be high. And the way that you accommodate the risk is typically by balancing the cash flow. And that's the part, the cash flow is dependent on your income. Because for me, I'm not necessarily going to suggest that everyone needs to find neutrally or positively geared properties, because you might be on 300-400 grand combined household income, but you've got 50 to 80 grand disposable a year. So nursing as 20, 30, 40 grand a year negative component across 3, 4, 5 properties might not actually be a bad idea, because you factor in some depreciation, some negative gearing, all of a sudden you're back to maybe a 5, 10, 15 grand a year negative position. So if you're holding an asset base that's quite well leveraged at the early stage, you've got a mindset of 10 years, 15 years, 20 years, the reality is you're going to need those 3, 4, 5 properties, build them up over a period of time. And it's going to mean that you're not going to be paying off those assets. What it's going to mean is you're relying on capital growth across the base, and you're probably going to have a couple of properties that will be sold off or reducing the debt on the remaining portfolio. And that remaining portfolio is the properties that ideally are typically going to be the ones that are high cash flow, potentially value add, whether it's, might be as simple as a granny flat to add cash flow. It might be a subdivision you can add an extra income, extra equity to. But it's usually going to mean that there's 2, 3, possibly 4 assets you hold. Likely over the long term, it's 1 or 2 assets that you're going to sell over that sort of 15, 20-year period. So the things that as I'm speaking, the things that I know that are really relevant, 10 years, I say, is a minimum for the growth. But if you're going to be investing with the intention to get to 100 grand a year passive income, you need to get leveraged, you need to balance your cash flows, and you need to have probably a 20-year horizon. So, working backwards, if you want to be going surfing for a living, if you're age of 30 now, get busy, because by age 50, you should be able to achieve that if it's done correctly. If you're 40, set your horizon to say 60. The big thing that I haven't talked about as well, which most people don't necessarily consider, you've got super, and let's take that off the table. Let's say that's ring fenced and that's going to do what it's designed to do. But the vast majority of people who do buy their own home, I'm attest to it as well. I've got my own home. That's my forever home now. Will this be for my forever home for my wife and I when our kids fly the coop in 15, 20 years? Likely not. It's too big. It's not going to suit our need, but it's probably worth more than what I'll need as my purchase after that. So I've got a chunk of money that I can then take tax-free to then go and offset this other asset base that I've got. And then all of a sudden, that's another way to make sure that asset base becomes highly cash flow positive and can feather my nest, so to speak, as far as delivering me an income later in life.
That's a really interesting one, because the principal place of residence tends to be of a higher value than your portfolio would be, because that's where you live, right? You want it to be nice.
Exactly.
But of course, a downsizer, the clue is in the name, right? You go smaller because you're not going to need 4 or 5 bedroom home with 2 living areas and a rumpus or that sort of thing. So that's a potential to put that cash not just into the downsizer, but paying off some of the debt on that portfolio. So let's say we're at that sort of 4 or 5 property mark, and we're considering selling off a couple to bring the debt down so we can really start to see some positive cash flow. Is that something typically people will only do in retirement, or is that something that you can choose to do at any point in time? Let's say you are 40 years old and you've been doing this since you were 25, 30. It's just a question of, well, when do you want that financial freedom? But I'm guessing that puts a cap on the potential upside from there, right? Because if you're selling interests in property, your future growth would be less, but you're bringing the freedom forward. Is that right?
Yeah, so accurate there. And I think that's the key, is it depends when you start. But if you started at age 25, 28, and you're maybe early 40s now, and you're sort of thinking, well, I've got this property portfolio, I've got a lot of equity in it. I'm thinking, well, is this a crossroads? Do I keep adding to it and make that end result much bigger, but delay that gratification further? And if you've been doing it for 15 years, you've done well to hold that long anyway. I can speak to a client that I actually caught up with yesterday who we've bought 4 properties over the last 7 years with them. They've got their own home. I think they've got now technically about $17,000 in debt on their own home, fully offset. They've got 4 assets across Brisbane, Adelaide, and Perth. Those properties are worth about $1.8 million gross. Their debt on those properties is about $900,000. They've seen about 60 odd percent in growth over that's 5, 6, 7 years since they've owned them. They've obviously leveraged their equity from their principal place of residence to get started, but now they're considering, on the back of these interest rate rises, they're mid-40s. They've got a good wedge in super. They kind of don't want to work to 65, and they're sort of saying, like, ideally the wife wanted to go part-time in the next couple of years. The portfolio is slightly positively geared by about 20, 25 grand a year at the moment. They ideally need to get about 40, 45 grand to make that decision to go part-time. The decision is they're going to sell the Adelaide asset. The Adelaide asset probably had some decent growth, but the cash flow was never going to be more than a very mundane sort of 3-ish% gross rental yield. So they're going to take that off the table. They're going to take that $200,000 that they get from that sale. They've held that property for the longest, about 6 or 7 years. But that's then going to bring down their overall debt profile, bring up their cash flow position. They're not going to add to their portfolio any further. But that is a solution that comes into the fold a lot earlier than technical retirement. They've got 2 teenage kids and still in the prime of their life at mid-40s, but they want to make the most of it. They don't want to be saying we'll work another 20 years so we have lots more money. They're saying the money and the position we've got is good enough. Let's try to make the most of what we've got now.
So that's where, rather than the hot spotting, and I must say I am very disappointed I'm not going to get that clickbait article where Paul Glossop says buy 10 properties and you'll be set for life. But it really comes down to what you actually want. So what do you want to get out of property investing? What do you want your life to be? So, do you want to build $100 million portfolio just because you want to say that you've got it? Or do you want to retire in your 40s because you want to do whatever it is you want to do? So is that something that you help people with when you're onboarding? Because I'm presuming a lot of people just come to you and they say, I want to be a property investor because, well, I think that's probably a good idea financially, but maybe not having much more substance or plan than that.
Bingo. Like that's, and most people start there, and you've got to start somewhere, obviously, but you've sort of realized that there's usually 2 ways to make additional wealth in life in the world, is that one of which is potentially equities, or I'll probably add in being potentially starting a business or something to that effect might fall in that category as well. It's obviously got some downside risk to it in addition to the upside. But then the most tried and trusted is property. So people realize that this is a way that people make money over the long term, but not necessarily knowing how do I get there, where do I start, even how do I structure loans, all the basic fundamental components. So that is always going to be where we start, is that let's devise a plan. Let's not worry about going to a solution. And the solution is going to be different depending on what the plan looks like. And that's the big one, is that I'm really reluctant to tell anyone to say, go buy properties here or there, because I can attest to the fact that we're buying properties in 4 states right now. And, we open this conversation by saying between $300,000 and $3 million. And I can guarantee none of those properties in that bracket are for the same client. They're simply going to be for different clients at different stages. And that's always going to be the case. So that is the part. And don't feel like you need to rush that part, because property simply does not move as quickly as most people like to say it does. Even if markets are booming, they might move a couple of percent in a month at the best of times, and they might go down a couple of percent at the worst of times. So, compared to places like the bonds and equities markets, you can be quite pragmatic. Take an extra 4 weeks to set up a plan. Take an extra month to get your finances set up correctly. Even have a good chat with a property-focused accountant, just to make sure that you've asked all the questions for the structures just before you go put pen to paper on something, because the property itself is always going to be the last part of the overall plan and the overall solution.
I love that, Paul, and there's an absolute ton for people to unpack in that. Thanks for sharing your time and that investment goal today.
You're very welcome, mate. Fantastic. And thank you again for having me.
Of course. Cheers.